Every trader wants to find that one pattern, that one thing that they can get into the market with little to no drawdown, minimize their risk, and maximize every pip of profit that goes in their favor. I'm going to show you that pattern that I use every single day on every single trade, whether I'm going long or short. The pattern that I'm referring to is the pump and dump and the dump and pump pattern. You may have also just in general heard of the pump and dump schemes with like crypto and other assets as well, where the market will run something up really fast and then it'll just dump it all the way back down. So what I'm going to do is I'm going to show you how to identify these patterns, because they occur every single time the market moves in a direction. Anytime the market goes up, anytime the market goes down, it uses this method of pump and dump or dump and pump to move the market from going one direction and then shift it into another direction. What are the pump and dump and the dump and pump? P&D, D&P, all right? So just for future reference, that's what those mean. Every single market movement is one of these two patterns. So, thinking about how I trade, right? I use larger setups and then I start to break things down. I look at the day, I look at the 3-day cycle, I look at what day are we in the week, and I look at essentially the weekly range. What is the high and the low of the week? Are we working the low or are we working the high? So I have a lot of considerations that go into this, but this pattern is always going to remain the same. And with this pattern, right, all trade setups are based off these two patterns. So that's what I just said. Defined, a unidirectional move that ends with a consolidation, a break-in structure, and a reversal. So in this picture here, on this chart, you can see this is ranging over multiple days. And the market is pumping up, pumping, pumping, pumping. And then at one point, there's a high where the market starts working that high. And you can see that we've gone into consolidation above that level, right? Now this trend line is for general awareness, right? We're making higher highs, higher lows. It's respecting that trend line. It breaks through. I understand we don't trade trend line breaks. It's just for a visual, okay? Now, this high, they're working that high and it consolidates above and then breaks down to the downside. You get a peak low, peak high. Markets are fractal, okay? So this pattern is going to occur on the 4-hour. It's going to occur on the daily chart. It's going to occur on the 15-minute chart. It's going to occur on the 30-second chart, the 15-second chart. It doesn't matter. Whatever you're looking at, this pattern is going to occur. It can become more clear on certain charts because of just how the market's moving, and it occurs more frequently, obviously, on lower time frames. You need to have a good, solid understanding of market structure if you're on a lower time frame, so that way you don't get caught, in the wrong direction. Let's go over some characteristics and nomenclature of this pattern, so that way you can further identify it within your trading and you're not guessing, right? I like to put rules to everything. I like to list things out and I like to make them solidified with these notes so that you can go back and review this slideshow. It's going to be in the description down below. You can go back, print this off, hang it up, whatever you want to do, or you can just use the link down in the description to follow along with this video. But let's get into some of the characteristics and nomenclature. We have this pumping pattern, right? Just like I showed you on the last slide. Pump, 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 pump. We have a high that becomes relevant. Death line up top where volume is getting trapped, right? This is the trap volume, trap traders, whatever you want to call it. The high that's getting worked. And then it breaks down below that relevant high and doesn't go back above there, okay? So you got your pump and then now you have your dump. Now, this target down here, this is where the pump began. This is where the move originated. This is where they came out of consolidation the last time, and they gave 3 subsequent pushes of some kind. This could be considered a 1, 2, and a 3. This is the M up top, and then they break down, right? They come out of consolidation, you get 3 pushes of some kind, and then the trap volume, and it breaks to the other side. This can occur in both directions, right? If I were to flip this chart upside down, the pattern remains the same. You just have to, look at it a little bit differently. So you have your relevant high that I just talked about, all right? We're going up. You could mark it off on this pen or on this candle closure right here, this bull candle, whichever one. I just look for the bulk of the volume up top. So once the market has made a high and then failed to make a new higher high, and then it starts to fail again, right? I'm making sure that I'm marking off these levels so that way I have a good sight picture of what's going on. Trap volume is the consolidation after an impulse unidirectional move above that relevant high. So you have impulse move, and we're above that relevant high, obviously working up top. All right, the death line. The death line is the level, the area where I've marked off the bulk of that volume up top. Once they come below that line, everybody up top, it should be solidified that those people are stuck. They shouldn't come back up above that line. So the target, in most cases in a pump and dump, even on a larger scale, right? So like things with like, cryptocurrencies or whatever, right? The larger pump and dump schemes, wherever that pump begins, a lot of times the market will return to that level. And that's a very important thing to understand and to realize. So this move, we came at a consolidation down here, we started pumping, and then you can see we've now returned back to that level. So breaks in structure, it's not shown necessarily on this chart here, unless you consider the higher high, the break, and then the attempted retest and follow through, right? So this would be a low, a higher high, a lower low, and a lower high for the continuation. So not a very or super clear break in structure, right? We got a low right here that is broken, and then you've got entry opportunities over here if you were waiting for that solid break in structure. So a break in structure is, it displays that the market could be about to change directions, but first has to trap people, or it has to go through the checklist of the market behaviors, right? The market's moving in one direction, and then it's always trying to accomplish something, whether you're thinking about it or not. The market's either trying to get you to behave a certain way, it's trying to induce behavior, trigger breakouts, hit stops. It's always about the money. The market is going where the money is at. It's also trying to, like I said, get you to do something or behave a certain way. I think that we've all sat there and watched candlesticks move very quickly and very aggressively in a certain direction, only to go in the opposite direction. And you think, well, it's moving so quickly, why did it stop? They were inducing a certain behavior. Behavior, trigger breakouts, and then go in the intended direction. All right, so we've got a breakout, fake out candle. Notice how they break structure to the downside, and now they've initiated the process, right, of getting behavior. So they have a super strong move up, right, this big bullish candle. On every textbook that you read, get in on the bull candles, the big solid strong looking ones, right? And then it immediately starts to roll over, up, and then down. So it's like a little micro M. After a larger M, right, we've got patterns within patterns. There's an M there, there's an M there, and then the larger structured M, right, the larger consolidation up top. So just look for these patterns within the patterns on the 1 minute chart. And this is a 1 minute chart, by the way. And then you've got your high bull and your low bear candles. And of course, I'm going to get into what those are. Basically, it's just up top, right? So you've got a high bull candle that gets engulfed by a bearish candle. That high bull candle will act as an area for selling. And then down low, if you have a low bear candle that gets engulfed by a bullish candle, that area can be an area for buying. Basically, if you want to think about it other than high bull, low bear candles, it's like a supply and demand zone. So one of the things that I mentioned with this pattern is that it really does help you with your entries, right? If you have an understanding of this pattern, you understand that once they come out of consolidation, there should be 3 subsequent pushes, and then they go into consolidation and then manipulate the market, and then you're looking for either a reversal or some kind of behavior to let you know, hey, this market could be flipping. This might be a pump and dump pattern. A good one, right? If there's 50 pips, 75 pips of movement up, and you have the understanding that a lot of times the market will return all the way back down to where that move began, you have 50 to 75 pips of room for your trade to go through. Helping with entries. My entry criteria, I've got it up here on the screen. This is the criteria that I use for every single trade that I take, every single one. The pattern remains the same. My entry criteria remains the same. The only thing that changes is which trade setup I'm looking to take for that day. That could be a day 2 trend, a day 3 reversal, a day 3 trend. It could be a first red day, first green day. I could do an inside bar play on the daily chart where the previous day was an inside day and I have an understanding of the inside bar. So if you want to see any of those other trade setups that I'm referring to, please go back in my channel, and I've got videos on all of them. So my entry criteria is as follows. I have to have a high or a low formed. Okay, so we've got this high that's formed right here. If you want to call this the relevant high, right? So I've got my death line, the bulk of the volume up top, right here. Okay, so this is the relevant high that we are now working above and trapping. I've got my high formed right here. All right, I need to trade back into that level in 3 pushes or some sort of 3 push variation. Again, I have lots of videos or other videos on the different variations of the 3 push pattern. But I've got 1, 2, 3. This is a 3 push stair step back up into that high that's already been formed. And then this is a micro M. Okay, you get up, up, and then it breaks to the downside. There's your neckline right there. And this is also, you know, the break to the downside. They've broken to the downside. They've come up and gone into consolidation. And then you get this 3 push triple top, another 3 push variation. You could enter in here. You could enter in here, whichever one. Now, this is a very large push down, so I'd be a little bit weary about entering in. I do remember what this was, though. This is only about 5 pips back up to the top. Okay, so it's a 5 pip stop loss, regardless of how big these candles are, so maybe that would be okay. 3 push triple chop, you have lots of entry opportunities as the market is following through. So the other things that I look for, though, the engulfment, right? You got your engulfments right here, and the pin hammers, right? Pin hammer doesn't necessarily have to be a textbook perfect pin. It just needs to be a candle with a large wick at the top or at the bottom if you're going long. And then time engulfments. I don't have the times listed on here, but I would be looking for 15-minute opening times and evidence that the market has trapped people up top and then released, you know, come back down and solidified that move, solidified that everybody's stuck up top, which is the same concept as the death line and the break-in structures. Something I'd like to say real quick about these break-in structures, and I'm going to talk about it in later slides, is this break-in structure is the initiating thing, right? That's the thing that sets the market in motion for downwards movement or upwards movement, right? If it's been going up, this is the thing that says, hey, the market's out of whack, look for the pattern. Break-in structure, that's where my trade begins. Now I know, hey, first mouse, all right? Remember that. First mouse is trapped in the market. Those are the people who traded the breakout to the downside anticipating this, but they just got in a bit too early. So now the market needs to stop those people out, induce behavior in the opposite direction. All right, people are in the market. They come back up. Maybe their stops are, you know, above this candle or at the high of this candle, maybe midway through the candle, whatever it is. They get this 3 push variation, inducing behavior to go long, and then they solidify the move down. The pattern never changes. The market never changes. It does the same thing over and over and over again. You just have to understand and look for the behavior. So the pattern itself, if I am trading only the pattern, that is me trading movement. All right. The pattern occurs over and over and over again on all different time frames. But if I am trading only the pattern, I'm trading movement. I need to make the pattern relevant using a larger trade setup and a larger trading idea, such as the first red day, the first green day, 3 days of previous day's high being broken, previous day's low being broken, you know, the short squeeze criteria that I have in previous videos, the parabolic trend trades in previous videos that I've gone over. I need to make the pattern relevant and only use it as a way to get into the market and find, you know, filter pairs based on the pattern. So that way I have adequate movement and risk to reward opportunity. So let's go over some of the things that I look for. All right, I need to be in my timing window. I personally trade the New York session, but the other timing windows are Asia from 8 to 11 p.m., London from 2 a.m. to 5 a.m., New York, the currencies, all right, I know I have 8 right here, but it's 7 a.m. 7 a.m. to 11 for currency pairs. A lot of times those currency pairs will start their move at 7 o'clock Eastern Standard Time. And then everything else is from 8 to 11. These times are all Eastern Standard. That's Eastern United States, New York time. Then I use the round numbers and the quarter levels, and that is the price. These areas can act as support or resistance. They are bank institutional levels, and you know, they're areas for trapping volume, trapping traders in the wrong direction. You'll notice that a lot of the work is done around the double zeros areas. If you have the understanding that the average stop hunt is 25 to 50 pips, you can use that to your advantage in both directions, right? So if the stop hunt has already occurred and the move is down, the stop hunt has already occurred and the move is down, maybe that's a pump and dump. Or if you're looking for the stop hunt and it hasn't occurred yet, 25 to 50 pips, if you're counter trending something, you understand that, hey, 25 to 50 pips is the average stop hunt and I'm trading counter trend. This might not go that far. you have lower expectations and you can manage your trade accordingly. So some of the trading setups that I look for with this pattern, right? The pump and dump pattern or the dump and pump pattern, like I've already gone over multiple times now. First red day, first green day, inside days, 3 days, previous day's high or low being broken. Day 2 trend, day 3 trend, day 3 reversals. If you're curious about what I'm talking about with these day 3s, go back in my channel. Again, I've got lots of 3-day cycle videos. Regardless of the trade setup, entry remains the same. I'm using that pump and dump and pump pattern, as well as my entry criteria. There are lots of areas of interest to look for using this strategy, which is why a lot of people will say that it's not as simple as you make it out to be. I highly disagree, because you have to understand the different concepts and the different categorization of the strategy. Things are broken down very simply within the strategy, and a lot of things are just considerations, not the main strategy, right? They are considerations for the strategy. These areas of interest are simply considerations. You don't have to have every single one of them up on your chart. You just have to be aware that they exist. You have to be aware that if we're pumping, hey, what are we looking for? Are we going for something, a different level? Previous year's high, previous month's high, previous week's high? Are we consolidating below a level like previous week's high, etc., looking for that parabolic trend move? You know, you just have to be aware of these levels. And those levels are the previous and current months, high, low, week's high, low, day, session, the previous and the current 4-hour session. You have to understand those ranges. And of course, the previous and the current 1-hour candle. And having an understanding of all of those levels will help you to develop a thesis based off of the larger trade setup, okay? So you've got, if I were to break it down from top to bottom, you have your larger trade setup, then you have your areas of interest, then you have the pump and dump or the dump and pump pattern, and then you have the entry criteria, and then from there you have your trade management and so forth. Now, I've talked a lot about the considerations and other things in the slides. I want to go through a few examples now. I've got my trend line, I've got my relevant high, I've got my death line up here. You have, now, remember I talked about that high bull candle acting as an area for selling. Also, if you want to call it supply and demand zones, whatever. The last bull candle, and then this candle was engulfed, all right? Now look, they're working that candle. They break out of the trend line. They break to the downside and then pull back inside. Cool, that's all that's happened. This is your first mouse. Now look, this is the 7 o'clock open. They pull it back inside in 3 pushes. 1, 2, 3. Micro M. Break down, pull back, and then there's a range expansion of that consolidation. Now I've removed a lot of words off this slide, and I've just left the image alone. If I were to look over here, just go over here. A run up, a relevant high, a consolidation with a good pattern, it breaks down. A run up, a consolidation, it breaks down. A run up, a consolidation, it breaks down. If I were to look down here, it comes down, it goes into consolidation, it goes back up. Start the pattern over again. Goes up, goes into consolidation, it breaks down. Okay, the pattern is always the same. It's the same thing over and over again. Now I have highlighted this one because this is the one that obviously went the full distance. But if you were just trading this, your risk to reward still could be good. If you traded this, your risk to reward could have been fine. You've got a couple pips of risk to get 15 pips. If you're risking 3 pips and you get 15 pips, you know, risk to reward, risk to reward wins the game. You have a run up, a relevant high, a consolidation, a very solid head and shoulders 3 peak pattern, breaks down, pulls back, and then continues the move down. All right, so this is gold. This is the 1-minute chart. I'll zoom out real quick so you can see the overall picture. We broke through the previous day's low, okay? And this was a double inside day. So we had a double inside day, and now we have broke out of that inside bar. And just look at the pattern, right? It starts sliding. We get this little slide going, okay? It's not going much lower. It goes lower, we get a big W, and it comes up, comes down. All right, now this is what got me very interested. We have a break to the upside here. They come down and fail to make a lower low. and we get this channel. I love these channels, okay? And I like seeing the behavior of them trying to get you to do something and then it not performing, okay? Notice how they are slamming, absolutely slamming price down. Big candles, 1, 2, 3 down. 1, 2, 3 big candles, it must keep going in that direction, okay? They're getting you to behave a certain way, but then it doesn't behave how it should. All right, so let's break this down a little bit more. We have a break in structure on a larger time frame as well as a smaller time frame to the upside here. Behavior, getting you to behave a certain way, and then the run up in the other direction. How the heck, Cameron, does this apply to pump and dump and pump? Lower low, lower high, lower low, lower high. Okay, so I'll connect all of those with my fancy little line. Now, where's my relevant low? Well, there's my relevant low. Look, they're working, they're working, they're working. Where do they solidify the move? Where's my death line? Well, there's my death line. That's the line where the bulk of the volume is trapped. Where was the first mouse? Well, they got the first mouse right there. And then they go into consolidation. Notice the pattern, a ascending triangle right here. They complete the pattern at 9 o'clock, right at 9 o'clock. Run it up. They break structure to the upside again on the 1 minute chart. 1 candle, 2 candles, tweezers to the downside, 3 candles, engulfment. All right. If you're not in here, absolutely, start. Also, I want to point out the peak formation high, peak formation low, consolidation on the inside. We have a consolidation under a lower peak formation high. They run that. Okay, you have to look for these little itty bitty things with market structure, even down to the smaller time frames, and it's really, really going to benefit you finding the larger picture. All right, now my higher time frame analysis, of course, is on the 15-minute chart for gold. Double inside day. We've come down dang near to the low of this other inside bar. All right, but we've already broke out of this inside bar from Monday. So now all of these people down low could be stuck. They're stuck. Where are they going? Where are they going? First place, right? Going back to get people who traded the breakout of the inside bar. Now, with the understanding of what the pattern looks like now, and having the characteristics and having the understandings of maybe a little bit more about market behavior, please go back, rewind this video where I'm talking about inducing behavior and some of the things that they do to get you to behave a certain way. Those are all little key things that go into me making trading decisions on a daily basis. I really hope that this video has been beneficial. If it has, do me a favor, go down, hit the like button, let me know in the comments. You'll have a wonderful day.